Hey everyone. In this video, we'll walk you through trading chart patterns like an expert. You'll see exactly how we implement these strategies when trading stocks and crypto. There are countless trading patterns, but we'll focus on the ones that work best. These are the most effective and frequently occurring patterns in the market. Let's dive straight in, beginning with the first one, the double top and double bottom pattern. Here's where we break down each pattern structure. First, price moves in an uptrend before hitting two equal highs. These peaks create a resistance zone, while the low between them forms the neckline. So, what does the double top indicate in terms of price action? It signals that buyers lost momentum, failing to push the price higher. This loss of strength from buyers suggests a potential reversal. Now let's look at the opposite scenario. Price trends downward before forming two matching lows. These lows create a support zone, while the high between them becomes the neckline. So, what does the double bottom pattern reveal? It shows that sellers failed to push the price lower, signaling a momentum shift. This loss of selling pressure suggests a possible trend reversal. This brings us to the next big question. How can we integrate the double top and double bottom into a trading strategy? Also, drop a comment below with topics you'd like us to cover next. We always use your feedback to decide on future content. There are 4 primary ways to trade these patterns. Let's start with the first, the neckline break entry. When a double top forms, the neckline is set at the recent swing low. Once price breaks below this level, making a lower low, it confirms a trend reversal. That's when you take a short position to ride the new downtrend. For a double bottom, the neckline forms at the recent swing high. Once price breaks above it and reaches a higher high, the trend change is confirmed. At that point, you take a long position to capitalize on the uptrend. Now, let's move to the second method, trading a double top or bottom when it aligns with a key price level. This setup appeared on Ethereum. First, you identify a key level where price has reversed multiple times. As price revisits this level, a double bottom forms at support. To confirm the reversal, place the neckline at the swing high. When price breaks above the neckline, it signals an uptrend shift. This is your entry point for a long trade on lower time frames. Another confirmation method is to use a trend line connecting swing highs. Once price breaks above the trend line, that's another sign of reversal. Now, let's see how this works in a downtrend. First, identify a key resistance level based on past price reversals. As price revisits this area, a double top pattern forms. To confirm the pattern, place the neckline at the swing low. When price breaks below the neckline, making a lower low, the downtrend is confirmed. That's when you'd enter a short position on lower time frames. This example also highlights multiple trade entry opportunities. Some traders enter short immediately at resistance. Others wait for confirmation from the neckline break. Pattern traders typically wait for the double top to complete before entering. All these approaches are valid. Your choice depends on your trading style. So, what makes a double top or bottom at a key level so powerful? It increases trade quality because multiple traders are watching that level. Pattern traders and support resistance traders both enter, creating strong momentum. Now, let's explore the third approach. Instead of entering on the breakout, waiting for a pullback entry. Returning to the Ethereum example, we see a double bottom with a neckline break. Instead of entering right away, traders could wait for a retest of the new support. This level had been established previously, making it a high probability entry. One crucial aspect is stop loss placement, which varies based on entry type. A breakout trade requires a different stop loss strategy than a pullback trade. Now on to the fourth approach, using candlestick formations at key levels before a double top or bottom forms. First, identify a key level based on past reversals. As price reaches this level again, look for candlestick reactions. A long wick candle signals a reaction, but that alone isn't enough for a trade. Price could still break through, so we need further confirmation. This is where lower time frames help refine entries. Switching to a lower time frame reveals more price movement details. On the daily chart, price action might seem choppy, but on a 6-hour chart, clear swing points become visible. In this case, a double top formed precisely at resistance. The neckline is placed at the swing low, confirming the trend change. When price breaks below the neckline, the reversal is confirmed. That's when traders look for short entries on lower time frames. Now let's flip this scenario for a downtrend. If price was trending downward, the same logic would apply in reverse. If you'd like to support us, don't forget to hit the like button. Make sure to subscribe and turn on notifications so you never miss an update. Diving into the triple top and triple bottom pattern. Let's start with the triple top. This pattern typically forms after a strong upward trend. You'll see the price reach the same high point 3 times in a row. This repeated resistance forms the triple top. Between these highs, the price dips slightly, creating swing lows. These swing lows mark the neckline, which also acts as a support level. Once price breaks below this neckline, it signals a confirmed reversal, making it a good opportunity to consider short entries. Now let's look at the opposite, triple bottom. This one forms after a downward trend. Price hits the same low point 3 times, showing strong support at that level. Between those lows, the price pulls back slightly, and the peaks of those pullbacks form the neckline, which acts as resistance. When the price finally breaks above this neckline, it confirms the reversal and becomes a signal to look for long entries. The way you use the triple top and triple bottom patterns is quite similar to the 4 variations we previously discussed with the double top and double bottom. So we won't repeat those here. Trend continuation patterns. When you're looking at a bullish trend continuation pattern, what you'll notice are strong upward moves followed by slight pullbacks. Each swing high climbs above the one before it, and each swing low is also higher than the last. This basically tells us that the market is in an uptrend. Price action is creating a series of higher highs and higher lows. It's a clear sign that buyers are still in control, pushing the market higher rather than moving sideways. Now, flipping to the other side, with a bearish trend continuation pattern, you'll also see moves followed by pullbacks. But in this case, every swing high is lower than the one before, and the same goes for the swing lows. This signals that the market is in a downtrend, forming lower highs and lower lows. From a price action perspective, it reflects sustained bearish pressure, showing that sellers are driving the market lower instead of it just ranging sideways. Trend change patterns. Super important if you're trying to read the market. Let's start with a bullish market. There are a couple of ways a trend change can happen here. First way, you've got the price moving up nicely. Higher highs, higher lows, classic uptrend. Then suddenly the price dips and makes a lower low. That's your first clue that the trend might be shifting. Second way, same idea. Price is trending up with higher highs and higher lows. But this time, instead of just making a lower low, it also fails to make a new higher high. So now you've got a lower high and a lower low. That's a stronger sign that the momentum is fading and buyers are losing control. Now let's flip it and look at a bearish market. First variation, you've got the price dropping. Lower highs, lower lows, textbook downtrend. Then out of nowhere, the price makes a higher high. That's a signal that the downtrend might be running out of steam. Second variation. The price keeps making those lower highs and lower lows, but then it switches up and forms both a higher low and a higher high. That's a pretty solid sign that sellers are losing their grip, and a reversal could be starting. So yeah, from a price action point of view, these patterns show when the market's momentum is slowing down, whether it's buyers or sellers. And that's usually when reversals start to happen. Let's start by breaking down the head and shoulders pattern. This formation begins during an uptrend. First, we see a peak. That's your left shoulder. Then, price pushes higher to create a new peak, the head, followed by a lower high, forming the right shoulder. The lows between these highs form what's known as the neckline, which acts as a key support level. What does this mean from a price action perspective? It signals that buyers are running out of steam. The formation of a lower high hints at a possible reversal, a shift in trend direction. Now, there's a more advanced version called the slanted neckline. It's similar to the standard version, but here, price has already formed a lower low, slanting the neckline downward. This makes it a stronger reversal signal because both a lower high and a lower low are present, confirming a full trend shift, not just the beginning of one. Let's flip things around now and look at the inverse head and shoulders pattern. This one shows up in a downtrend. It begins with a drop followed by a small recovery, the left shoulder. Price then dips further to create the head and rises again, this time forming a higher low, which is the right shoulder. The highs in between create the neckline, acting as resistance. This pattern suggests that sellers are losing control. A higher low often points to the start of a bullish reversal. Just like before, there's a higher quality version here too. The slanted neckline, inverse head and shoulders. In this setup, price has already made a higher high, causing the neckline to slope upward. This setup is considered more reliable because the trend change is already in progress, with both a higher low and a higher high already in place. Use of head and shoulders pattern. Let's break down the three main ways to use the head and shoulders pattern in your trades. The first method is the breakout entry at the neckline. You identify the head and shoulders pattern and draw the neckline by connecting two key points. When the price breaks below that neckline and makes a lower low, it's a signal to enter a short trade, confirming a possible trend reversal. For an inverse head and shoulders, once the price breaks above the neckline and forms a higher high, it's your cue to go long. The second approach is to wait for a pullback after the neckline break. Instead of entering at the initial breakout, you wait for the price to return and retest the neckline, now acting as a support or resistance level, giving you a second chance to enter long. The same concept applies to a regular head and shoulders, where the pullback to the neckline offers a short entry. Now let's look at the third variation, an early and more aggressive entry taken at the right shoulder of the pattern. Typically, traders wait for a confirmed neckline break in the head and shoulders formation before entering a short position. But this method takes things a step further by identifying a potential trade opportunity before the neckline breaks, right at the formation of the right shoulder. Here's how it works. First, you identify the left shoulder, then the head. The left shoulder usually creates a clear resistance level, which you would already have marked and extended on your chart. As price moves back up toward that resistance, you look for candlestick signals, like multiple long wicks, that indicate rejection at that level. Once those candles form, you zoom into that price zone to look for any smaller scale price action, suggesting a shift in trend. This is your confirmation that the right shoulder might be forming. To refine this entry, you can switch to a lower time frame, like the 4-hour chart, while keeping the higher time frame, say the daily, as your reference. For example, the resistance zone identified on the daily chart would appear at the same level on the 4-hour chart. If you spot a clear bearish pattern, such as a descending triangle forming at that resistance, it strengthens the case for an early entry. Once the triangle breaks down, that confirms the reversal from uptrend to downtrend and completes the right shoulder on the higher time frame. At this point, you'd move to even lower intraday charts to find a precise short entry. If you're enjoying this breakdown, don't forget to hit the thumbs up button to show your support. Triangle patterns. Let's dive into it. Triangles, channels, and wedges. These formations worked well together because of how we incorporate them into our trading approach, and you'll soon understand why. Let's first review the three primary patterns, beginning with the triangle formation. The triangle comes in three different types, starting with the ascending triangle. The upper boundary of an ascending triangle holds at consistent highs, creating a flat resistance level. The lower boundary rises with higher lows, allowing us to draw an upward sloping trend line. This setup can appear in both bullish and bearish environments. A bullish ascending triangle begins with a rising trend, followed by the pattern forming. A bearish ascending triangle starts with a falling trend before the pattern appears. Next is the descending triangle. The lower boundary stays at equal lows, forming a flat support level. The upper boundary has lower highs, allowing a downward sloping trend line. This pattern can also develop in bullish or bearish scenarios. A bullish descending triangle starts from an uptrend, followed by the pattern forming. A bearish one starts from a downtrend and then forms the structure. Now let's go over the symmetrical triangle. The upper boundary creates lower highs, making space for a descending trend line above. The lower boundary forms higher lows, supporting an ascending trend line beneath. This formation also appears in both bullish and bearish trends. A bullish symmetrical triangle begins with a price increase, then the pattern develops. A bearish symmetrical triangle kicks off with a downtrend before the pattern takes shape. We'll explain how to apply all of these in the strategy section coming up. Before we go further, here's the most crucial point in the entire video. When drawing your lines and spotting patterns, think of them as zones rather than exact points. Why? Because markets aren't perfect. Patterns won't always look clean or textbook. If you wait for perfect textbook setups, you'll miss out on most of the high-quality trades. Remember, the market is messy. Price action is unpredictable, and to succeed in trading, you need to learn how to navigate this imperfect and noisy environment. So the triangle pattern is finished here. Now it's time to take things a step further. Channels and wedges. Let's jump right in. There are three variations of channel patterns. We'll start with the ascending channel. The upper boundary shows higher highs, making it possible to place a rising trend line. The lower boundary forms higher lows, also allowing an upward trend line. These two lines run parallel and both point upward. This formation can occur in bullish or bearish conditions. A bullish ascending channel starts from an uptrend, then the pattern forms. A bearish ascending channel starts from a downtrend before forming the pattern. Next is the descending channel. The top boundary features lower highs, so we can draw a downward trend line. The bottom boundary shows lower lows, also forming a downward sloping trend line. These lines are parallel and move downward together. This pattern can develop during both bullish and bearish phases. A bullish descending channel starts with an uptrend before forming. A bearish descending channel begins with a downtrend, then the pattern appears. Then we have the horizontal channel. The top stays at consistent highs, creating a horizontal resistance zone. The bottom maintains the same lows, forming a horizontal support line. These two boundaries are parallel and flat. This setup can occur in both rising and falling markets. A bullish horizontal channel begins with upward price action before forming. A bearish horizontal channel starts with a downward trend before the pattern appears. If you're enjoying this content and want to support the channel, please hit the like button. It really helps us. Now let's talk about wedges, which have two key types. First is the rising wedge. The top boundary features higher highs, letting us draw an upward sloping trend line. The bottom boundary creates higher lows, allowing another rising trend line. What's crucial here is that both lines are converging and moving upward. This pattern can form in either bullish or bearish environments. A bullish rising wedge begins with an uptrend, followed by the wedge forming. A bearish rising wedge starts from a downtrend, then the wedge takes shape. Finally, we have the falling wedge. The top boundary forms lower highs, allowing for a descending trend line. The bottom side shows lower lows, making room for another falling trend line. The important part here is that both lines converge and move downward. This pattern also appears in both rising and falling markets. A bullish falling wedge begins with an uptrend followed by the pattern. A bearish falling wedge kicks off with a downtrend, followed by the wedge forming. Let's talk about how you can actually use triangles, channels, and wedges in your trading strategy. Let's dive in. The key to trading triangles, wedges, and channels is to follow the direction in which the pattern breaks. This can apply to any of the patterns we just went over. If the breakout is to the upside, you'd look to trade in that direction. If it breaks to the downside, you'd trade accordingly. Let's break down the different strategy setups. We'll begin with the first, spotting a trend, then identifying a pattern forming, and finally waiting for a breakout that continues in the direction of the original trend. This is what we call a trend continuation strategy. Here's an example with Tesla's chart. You'll notice an upward trend leading into a descending triangle setup. Just to clarify, any of the patterns we discussed could have appeared here. But in this case, it's a descending triangle. If the price breaks above that triangle, it's a signal that the trend is continuing upward. That breakout takes bullish strength, creating a new high. At that point, you'd start taking long trades on shorter intraday timeframes since the trend is now confirmed. Here's another one, Ethereum. The chart shows an uptrend first, followed by a descending channel. Again, this could have been any pattern from our list, but here we see a descending channel. If the price then breaks upward, you'd enter long trades in the lower timeframes, riding the trend continuation. This strategy works in a downtrend too. Take a downward trend where a descending triangle forms. Again, any of the patterns could apply, but here we have a descending triangle. If the price breaks below the pattern, continuing the direction of the downtrend, you'd then take short trades following that trend lower. Now let's move on to another setup. Spotting a trend, seeing a pattern form, and then watching that pattern break in the opposite direction of the overall trend. This signals a reversal strategy. For example, you might have a clear upward trend that leads into the formation of an ascending triangle. It could be any chart pattern from the common list, but in this case, it's an ascending triangle. Eventually, the pattern breaks downward, which goes against the original uptrend. This break indicates a possible reversal, meaning the trend is shifting from up to down. At this point, you'd be looking to take short positions once the price breaks below the pattern. Now, flipping this around in a downtrend, the idea works the same way. Let's say you're in a downward trend and a falling wedge pattern starts forming. Again, it could be any of the common patterns, but in this scenario, it's a falling wedge. When the pattern breaks to the upside against the main downtrend, it suggests a potential reversal. This time from a downtrend, to an uptrend. So you'd start looking for long entries once the price breaks out upwards. Now let's explore another variation. Recognizing a trend, spotting a pattern, and seeing a breakout in the same direction as the trend. But instead of entering on the breakout itself, this method waits for a pullback. This is a trend continuation strategy. Using Microsoft stock as an example, suppose there's a strong uptrend followed by an ascending triangle forming. Again, while it could be any pattern, here it's the ascending triangle. As shown before, once the price breaks above the pattern, a breakout entry would be valid. However, more cautious traders prefer to wait for a pullback before entering. That pullback often shows up as multiple candles with long wicks reacting to the newly formed support near the top edge of the triangle, and where a moving average also aligns, creating a strong confluence zone. Once there's a shift in the lower time frame trend, that's when you'd look to take long trades using your strategy and tools. Whether you go for a breakout entry or wait for the pullback, both approaches are valid. It really depends on your trading style. Remember that stop-loss placement is different for breakout versus pullback entries, and that's something we'll cover in detail later on. If you like this video, make sure to give us a thumbs up. So let's dive into the next one. Here, we're spotting a trend followed by a chart pattern and then a breakout in the opposite direction. But instead of jumping in right at the breakout, we're waiting for a pullback first. This is a reversal strategy. We're using Coinbase stock as an example. You can see the price was moving up before a descending triangle pattern formed. It could have been any reversal pattern from our list, but in this case, it was a descending triangle. When the price broke below the pattern, it signaled a possible reversal from an uptrend to a downtrend. That's when you could look for short trades. However, cautious traders might wait for confirmation through a pullback. In this case, we got that confirmation with a long wick candle forming at the new resistance, where the bottom of the triangle and the trend line meet. That's your area of confluence. Once you spot a shift in trend on the lower time frame, you could enter short positions using our strategy and tools. Now let's go to the second variation, a pattern forming right at a key level. You first identify this key level through a previous reversal. As price drops back down, you see a descending channel forming at this level. Again, it could have been any pattern, but here it's a descending channel. When price breaks out above the pattern, it confirms the reversal, and that's your cue to enter long trades. Let's move to the final variation. This one starts with identifying a key level, then spotting a candlestick pattern, followed by a chart pattern forming at that level. We're looking at Microsoft stock again. We've seen an earlier pullback entry, but this is a second chance using a new variation. Here are the strong signs in your favor. You're trading with the main uptrend, there's momentum from the pattern breakout, and the long trades that followed. Plus, you've got an area of confluence where the trend line, newly formed support, moving average, and Fibonacci level all crossed. As price pulls back into this zone, several long wick candles appear, reacting to that area of confluence. When you see those candles, it's time to dig deeper and examine the price action within that zone. You're looking for signs that the short-term downtrend is about to reverse into an uptrend. Even though the broader trend is up, this pullback is technically a short-term downtrend, which means price could still break through and extend the move downward if the reversal fails. It's important to remember, the pattern inside that zone doesn't have to be a wedge, triangle, or channel. Any reversal pattern from this video can work here. Now let's compare the weekly and daily charts. On the left is the weekly Microsoft chart, and on the right is the daily. The key level and area of confluence we identified on the weekly chart is the same one seen on the daily. In this case, we got a clear descending triangle at the area of confluence. When price broke out above it and formed a higher high, that confirmed a trend reversal from downtrend to uptrend. One key detail here, notice how the price didn't shoot up instantly after the breakout. It pulled back slightly before taking off. That's why two things are crucial. Use lower intraday time frames to find the actual entry using our strategy and tools. Understand where to place your stop loss. There's one specific stop placement for breakout trades and a different one for pullback entries. If you like this video, make sure to give us a thumbs up. And don't forget to subscribe and press the bell icon. That's it for today. See you next time.